Remember the late 90s? The internet was new, exciting, and full of promise. It felt like anything was possible, and if you had a .com at the end of your company name, you were basically printing money. In the middle of this frenzy, one company stood out, not just for its ambition, but for its adorable sock puppet mascot. I'm talking about Pets.com, the company that promised to revolutionize how we shop for our furry friends. Their story is a wild ride of soaring highs, jaw-dropping spending, and a crash so spectacular it became the poster child for the .com bubble burst. So, grab your popcorn, because today we're diving deep into the epic rise and fall of Pets.com. It all started in 1998. The idea was simple, yet brilliant for its time. Sell pet supplies online and deliver them right to your door. No more lugging heavy bags of dog food from the store. The concept quickly attracted investors who were eager to cash in on the e-commerce gold rush. With a ton of funding, Pets.com was officially born. They weren't just planning to sell pet food. They were building an empire. The website was slick. They had a huge variety of products, and they even hired a team of pet experts to answer customer questions. The stage was set for them to become the Amazon of the pet world. And for a while, it looked like they were going to succeed. To get their name out there, they launched one of the most aggressive marketing campaigns of the era. You couldn't escape them. They bought a Super Bowl ad for a whopping $1.2 million. Their sock puppet mascot was everywhere on TV, in magazines, and even as a giant balloon in the Macy's Thanksgiving Day Parade. This little puppet became a national celebrity. The hype was real. Everyone was talking about Pets.com, and in early 2000, they went public, raising $82.5 million in their IPO. On paper, they were a massive success story. They were the face of the new digital economy, and their stock was a hot commodity. But behind the celebrity puppet and the flashy marketing, the foundation of the business was starting to show some serious cracks. Here's where things get interesting. The business model, which looked so good on the surface, had a fatal flaw. They were selling heavy, bulky items like 40-pound bags of dog food. The shipping costs were astronomical, often more than the profit they made on the sale. To attract customers in a competitive market, they offered huge discounts and free shipping on almost everything. So, for every bag of dog food they sold, they were actually losing money. Think about that. The more they sold, the more money they lost. They were essentially paying people to take products off their hands. Their financial reports told a grim story. In the first 9 months of 2000, they made about $619,000 in revenue, but spent over $12 million on advertising alone. It was a classic case of burning through cash at an incredible rate, all in the hope of building a large enough customer base that they could somehow, someday, become profitable. But someday was a luxury they wouldn't have. Just as Pets.com was reaching the peak of its fame, the world around it was about to change dramatically. The year 2000 marked the beginning of the end for the .com bubble. Investors started realizing that many of these high-flying internet companies had no clear path to profitability. They were built on hype and speculation, not on sustainable business models. Panic set in. The stock market, especially the tech-heavy NASDAQ index, began to plummet. Money, which had been flowing freely to any company with a .com in its name, suddenly dried up. For companies like Pets.com, which were burning through millions of dollars every month, this was a death sentence. The party was over, and the hangover was about to begin. With the market in freefall and investors running for the hills, Pets, Com found itself in an impossible situation. They couldn't raise any more money to cover their massive losses. The flashy Super Bowl ads and the giant parade balloon were now just symbols of their reckless spending. The end came swiftly. In November 2000, just 9 months after their spectacular IPO, Pets.com announced it was shutting down. The company that had burned through over $300 million in investment capital was gone in a flash. They laid off their employees, liquidated their assets, including selling their famous sock puppet mascot, and closed their virtual doors forever. The collapse was so sudden and so complete that it became a legend, a cautionary tale for a generation of entrepreneurs. So, what can we learn from the spectacular flameout of Pets.com? It's a powerful lesson in business fundamentals. It doesn't matter how great your marketing is, how famous your mascot becomes, or how much hype you generate. If your basic business model doesn't work, you will eventually fail. You can't lose money on every sale and expect to make it up in volume. Profitability matters. It's a simple truth that got lost in the frenzy of the dot-com era. The story of Pets.com serves as a timeless reminder that behind every great idea, there needs to be a solid, sustainable plan to actually make money. Their legacy isn't the sock puppet or the Super Bowl ad. It's the simple, powerful business lesson they taught us all the hard way. Thanks for watching. If you found this story as fascinating as I did, make sure to hit that like button and subscribe for more deep dives into business history. Let me know in the comments which company's story you'd like to see next. See you in the next video.